Hey, everybody, and welcome back to the Teaching Tax Flow podcast, episode 144. Today, we are going to look at something that has likely come across your email in one way, shape, or form from Teaching Tax Flow or somebody else in the tax professional industry. We are going to look at the One Big Beautiful Bill Act and how that relates to specifically individual taxpayers. But before we do that, let's take a moment and thank our episode sponsor.
This episode is sponsored by Wealth Builders Mortgage Group, powered by Movement Mortgage, one of the top mortgage teams in the nation and a powerhouse in the real estate investing world. With over $1.1 billion in closed mortgage volume and more than 3,000 investor deals under their belt, they don't just talk the talk, they walk it. Their team specializes in helping short-term and long-term rental investors scale smart with customized lending strategies. They offer all STR loan products, including second home, investment, non-QM, bank statement, asset-based, and HELOCs. They also offer all primary home loan products too. Whether you're just starting out or expanding an existing portfolio, their unique Path of 10 strategy is designed to help you move from a 9-to-5 job to financial independence. If you're looking for a lending partner who truly understands the investor mindset, visit wealthbuildersmortgagegroup.com and start building your roadmap today.
Hey everybody, welcome back to the podcast. Today, obviously, as you heard in the intro, we are going to look at the One Big Beautiful Bill Act, or the OBBBA, or the OB3A. Million different ways to say this thing, I'm sure. But if you haven't heard anything about it yet, it is literally 1,100 pages plus. So you likely haven't understood or haven't taken the time to read every single page in it. If you have, kudos to you. I can't say that I have personally. Lots of information in there, lots of things. I think even the industry is still really trying hard to unpack and understand and figure out how it blends and kind of marries into other things that are already in existence and things that are supposed to change. But the best place, I think, we here at Teaching Tax Flow have seen this information kind of sorted out, right, is how it relates to individuals and then businesses. So individuals, individual taxpayers, and that's what we're going to talk about here today. So Chris Picciurro, welcome back, obviously, but I'm excited about this topic a little bit because really this is the first time I think we've carved out some significant time to talk about this, you and I. So a lot of it'll be new to me.
It's great to be back. I'm excited to jump into some of the individual tax changes. We are going to have just tons of content in the Teaching Tax Flow community. So that is not just this podcast, but it's also our YouTube channel, Teaching Tax Flow. Definitely subscribe. Our Defeating Taxes private Facebook group. It's kind of funny, John, because we have like an unlimited amount of content now with this, what we're going to call it the OB3. Not the Obi-Wan Kenobi, not the OPP, sorry, Naughty by Nature, but the OB3, the One Big Beautiful Bill Act. And you're right, it really is it's a massive paradigm shift in many ways. And but what we first want to tackle is because we're going to tackle some of state tax issues, we're going to tackle business, we're going to tackle real estate, we're going to bring on special guests. But let's talk about what you need to know right now. This bill was just signed in on 4th of July, very recently. So let's look at some of the individual provisions that are going to affect almost, I would say, all of the Teaching Tax Flow podcast viewers, if you're on our YouTube channel, listeners, if you're listening on your favorite podcast provider. So let's jump in, Johnny. And again, we're going, any questions that you have, this is your opportunity to say, I'm going to jump in to our private Facebook group. You can ask questions anonymously and ask a question or leave a comment on our YouTube channel. We reply to these things. Your questions drive our content. So it's very, very important. It's not a bother at all. This is a labor of love for us, John. The only payment we ask for from you is to like and subscribe and share our content if you like it. That's it. Which I think is very fair.
Oh,
So-
absolutely. Absolutely. And Chris, I think too, right? Like we refer to this. This is literally 1,148 pages or something of the sort. So there's so much information packed in this. Not only, I think we should take a moment and acknowledge the fact that somebody actually had to type this dang thing out. So whoever did that, whoever you are, specifically keyboard stroking on this, you're an amazing human being, regardless what's in this thing. But also too, like I almost lead into this a little bit. So as I mentioned, everybody, I think, even somebody like yourself's been doing this 25 plus years, right? It's going to take a while to unpack this and fully embrace and understand everything. So whoever you, the taxpayer, and speaking to the audience, uses, or is your tax partner, give them a little bit of grace in this. They're not going to know every single thing about this, within a week here. So we're all kind of working through this. And Chris, what you mentioned, this is a great opportunity. Ask questions, figure it out. If you don't get an exact answer from somebody immediately, just again, understand that this is huge, right? And there's a lot to it. So I just wanted to kind of preface the conversation with that just a little bit.
So what did the OB3 do? Well, from a big picture standpoint, it permanently extended many of the TCJA. John, I don't know I think you're slacking. I'm calling you out. I have not heard any jingles or any funny noises when we use an acronym yet. So
We'll bring it back. We'll bring it back in
Mhm.
this one.
All right.
Right
So
here.
TCJA, Tax Cuts and Jobs Act of 2017. So it permanently extended some of the TCJA provisions and added some new rules. We're going to talk today about standard deduction, child tax credit, SALT tax deduction, overtime deductions, and more. So the first topic that the OB3 did is it extended reduced tax rates. Those were going to expire in 2026, and everyone's tax, no matter who you are, was going to go up between 2 and 5%. So the lower tax rates, John, I know we've talked about this. I don't know when I said it, but you said that we're in the golden age of taxes, right? Because we're in a historically low marginal tax rates. Those marginal tax rates have been extended under OB3 because they were going to go bye-bye. It also increase the standard deduction for 2025. Now that the standard deduction, now remember, you either take the standard deduction based on your filing status, or you itemize your deductions if your itemized deductions are higher than your standard deduction. That standard deduction for married filing joint is for 2025 is an even $31,500. For single filers, $15,750. So that means that less people will be itemizing because the standard deduction is higher. So hey, that's a good amount of money for a standard deduction, $31,500 for married joint.
Right. And actually, Chris, really quick. So I know we did jump into that. Let's take a very brief moment if you can, and even just explain elevator pitch style. What exactly is a standard deduction? If this is the first time somebody's heard about that. I know we're kind of taking a step back a little bit, but
Sure. Well, like I said, every taxpayer gets to take a deduction and not pay tax on the first portion on a portion of their income. So for married filing joint, let's assume your income is you've earned $40,000 on your W-2 wages. No matter what your medical expenses are, mortgage interest, property taxes, charitable contributions, those all could be zero. And you still get a standard deduction of $31,500, meaning $40,000 minus the $31,500, you'd pay tax on $8,500. Now, let's say all of the itemized deductions, which are reported on Schedule A, exceed the standard deduction, then you get to deduct the itemized deductions instead. And I know we've got a podcast episode on I think we talked about Schedule A, or when is it right to itemize. But yeah, so that means that even if you have zero itemized deductions, you still get the standard deduction, and you get to take that deduction off of your taxable income. So one more example, if someone makes $100,000, a married couple, they're going to pay federal tax on the $100,000 minus the standard deduction of $31,500.
perfect. Basically, that's a packaged standard deduction wrapped up with a bow on it, given to everybody. Bit of
Absolutely.
sense.
Let's talk about child independent benefit updates, another big topic with OB3. So the child tax credit increased to $2,200 per child starting here in 2025. And the refundable portion of it is now $1,400, and that's indexed for inflation. Remember, with credits, and I think we have If we don't have a podcast, we know we have content on this. For sure, we have content on this. The difference between a refundable credit and non-refundable. A refundable credit means that if you have a $1,000 credit and you only pay $600 worth of federal tax, that $1,000 credit would wipe out the $600 of federal tax and you would get $400 back in your pocket. A non-refundable credit means that if you had $1,000 of credit and a $600 of tax, that credit could wipe out the tax, so you don't have any tax, but you don't get a refund for the $400. So the child tax credit's a hybrid credit. $1,400 of it's refundable, $800 of it is non-refundable for 2025. So now this is going to be, what I expect the ramifications of this is going to be is that I expect that tax refunds are going to be higher for the 2025 return because withholding you're withholding from your W-2 wages for most taxpayers are W-2 wage earners. Those withholdings were based on previous tax rates and lower child tax credits. So you might get a larger refund. We don't know what's going to happen. We don't know if the withholding tables are going to get updated by the end of the year. There's just a lot going on. But the child tax credit is raised to $2,200 with $1,400 refundable. And this credit is indexed for inflation. So in future years, based on the inflation, that child tax credit's going to go up. It was stagnant for a long time. So that inflation index is very beneficial for parents, just like yourself, John. If someone like yourself. The dependent care credit. I know one of your favorite topics is daycare.
He's pouring salt on a wound here, folks. Just so you know.
Well,
it's all
the
good.
dependent care credit, the maximum percentage increase went from 35% to 50%. So let's assume you paid, $1,000 for dependent care. That would be nice, wouldn't it? But let's say you paid $1,000 for daycare. The maximum credit previously would have been $350. Now the maximum credit's 50% of $500. Remember, a credit is better than a deduction. So up to 50% of what you pay for daycare could come back to you as far as a tax credit. And now those credits phased out, but there's a new two-tier phase-out structure for higher income households. So that's another pro taxpayer with young or school-age children credit. In the child and dependent care flexible spending account contribution is raised to $7,500. So what that means is that a lot of larger employers, allow you to go put money pre-tax into an FSA, and that money be paid directly to your child care provider. That way it just comes off of your taxable wages as W-2. That was $5,000. That went up to $7,500. So the bottom line is, with child and dependent benefits, very much pro families with younger or school-age children. So,
and these are some pretty significant changes. Like you mentioned too, they're very pro that. I mean, I think the overall impact of that, right? I mean, there's a lot of families that, this is a huge thing for them that are definitely lower, income earners, we should say. This is massive for them.
Right. Oh, absolutely.
Mm-hmm.
Now, let's talk about some new deductions, our next topic. During the election, we did 2 episodes. We did a specific episode for Vice President Harris's tax plan and for now President Trump's tax plan. And then we compared them a little bit. And some of them had the same thoughts, right? Or some of the plans sometimes have the same thoughts. Let's talk about some new deductions. The overtime deduction. So now there's up to a $12,500 if you're single, or $25,000 if you're joint, that you can deduct for qualified overtime pay. There are phase outs for high income earners. All right. But let's assume you have a married couple. Someone earned on a W-2 $85,000, and $20,000 of that was paid for overtime. Since they're married, $20,000 of overtime is less than the $25,000 max. That $20,000 overtime will not be taxable. Pretty crazy. Now, we know that these W-2s are going to get so much more complicated. John, I'm a preacher of this. There's no such thing as an easy tax return, right? So
And
it's
they just got
it's
more
going to be
difficult
less
for
and
you.
less, right? So like the W-2s now are going to become the W-2s are going to have to identify tip income and overtime deductions and all this crazy stuff. But that's
And
just
I wonder too, like, I mean, speaking for your private practice, right? Like you guys, I mean, obviously you have a niche in real estate investors, which, stereotypically, higher income earners of that. So I wonder really too from a we'll call it a standard or a normal, we'll never call it easy, taxpayer perspective. It's going to be interesting too, just how much or how long it takes or how good of a job a lot of these tax preparers and tax pros do of educating their clients of these, right? Because I mean, I see this now. I mean, I think me and my wife were speaking to this a while back. They're, in a position or in a company, right? You might have a ton of employees and they just they're hourly, they rack up a ton of overtime. Like they fight for overtime opportunities and they take it. I really wonder how many of them even know this exists now. It's very new, right? We're talking a week, but I I wonder if it's just going to kind of fly over their head when they do hear about it, or if they look at it as a planning opportunity, or just something to you know keep in tune of, right? But then also you look at the some of these other ones, right? And I think we're gonna speak on another notable new deductions and other items in here. It's going to change the way that people look at things, purchases, just the way they do things. I think it change their lives a little bit if they know about it, right?
mhm. Absolutely. It'll be very interesting how this is rolled out. And will there be withholding now on overtime, or can you elect out of it? The whole payroll withholding issues, they're going to be really interesting with this overtime deduction. Let's talk about another new deduction, the tip income deduction. So there are limits, right? But up to $25,000 per year for cash tips can be uh, is deductible. So let's say you're a server and your income is, you're paid $25,000 and then you earn $10,000 worth of tips. That $10,000 worth of cash tips are now not taxable. There are limits, but again, the tip income deduction, the overtime deduction, two big deductions that were not around before. The third one, you can now deduct your car loan interest. Now, car loan interest used to be deductible before I even started preparing returns, I believe, but now up to $10,000 of interest on qualifying personal vehicles per year are allowed as a deduction. So now, does that mean more people are going to itemize their deductions? Is that, there's just so much. So three new deductions that we're going to figure out how that's going to change and change things around.
And really, and
And
looking at just these 3 alone, right? I mean, to me, and again, not getting in the weeds, but I look at this as, I wonder how many people, because we're talking about, right? So even the tip income, again, we know this at a very small level right now, but they're talking about it was a $25,000 deduction limit. I wonder how many people now, would have never claimed any cash tips. They make it a killing, never claiming it, and now all of a sudden they're going to claim, you know, $24,993. And, it's just going to be interesting to see some of the data. And I know the IRS puts out, a data book annually. It'll be interesting to
Mhm.
see how a lot of this has changed. But then also, right, that personal vehicle one, I was really shocked to see that, honestly. I didn't expect that. I mean, I'm sure there was a lot of reasoning behind it. Maybe it'll stimulate the, new car market, used car market. Who knows? Because I know there's other, there's phase outs of some credits and whatnot, but it's interesting. Very interesting.
Absolutely. We're gonna be coming out with much more detailed content on all of these items we're talking about. Here's a big one, especially for people in those states that have an income tax. The SALT tax, not what you put on your hamburger. If you do put salt on your hamburger, but the SALT tax, state and local income tax. If you itemize your deduction, that SALT tax deduction uh, for married couples filing jointly was $10,000. Well, guess what? It went up to $40,000. That's, I mean, 400% now. So now you can deduct up to $40,000 in 2025 of state and local income taxes.
Mm,
And
you're paying a
that's a
lot in
big
taxes to get
jump.
that deduction. So,
Well, and
A
it
lot.
seems fair. Like, think about the theory behind this, John. Let's say you paid $15,000 of state of Michigan tax and property taxes. You and your wife only got a deduction for 10. That means that you paid $5,000 to another taxing entity, and you're not even getting a deduction for that 5,000 from the federal government. You're paying tax on money you had to pay tax on. It just didn't make any. So that SALT tax increase is very favorable. The mortgage interest deduction was made permanent. So more acquisition debt up to $750,000 is now still deductible. So if you buy a home, let's say you buy a property for 700,000, you take a mortgage out for 450. The entire since that mortgage is less than 750, all the mortgage interest is deductible. And MIP. Ooh, that means back when I was in college, I meant minor in possession, but we're not going to talk about that. We're going to MIP, mortgage insurance premiums, or PMI, right? Private mortgage insurance is now deductible again. So that's for people that aren't, sometimes people that get a mortgage don't put 20% down or put a little less percentage down and have to pay what's called PMI, which is because their loan is more risky than others, and they have to pay insurance on that, and that's now deductible. So again, SALT cap and mortgage interest, these are Schedule A deductions. Let's move into savings and educational provisions. There's something new called a quote-unquote Trump account, okay? These are new accounts for children that are born in 2025, or new accounts for children under 18 that will get a $1,000 deposit. So it's a way to put money into accounts for help younger people save. And the annual other people can contribute to these Trump accounts up to $5,000. So remember, we always had 520. We've not always, but for a long time we've had 529 plans. But that was earmarked just for education. So these are trying to create a little nest egg for children, and they're going to be called Trump accounts. We're gonna have more content on that as well. 529, and again, how this is going to get administered, who the heck knows, right? 529 plan expansion. Remember that there was a big change to the 529 plans where you can now take money out of the 529 and use it for K to 12 qualified education, but the limit was $10,000. That limit doubled to $20,000. And now vocational credentialing is eligible for taking money out of the 529 plan tax-free. So point is, more flexibility for 529 plan owners.
Mhm. And I think, Chris, as we talked on, obviously we have another episode that we're going to do more business focused after this one. There's a lot to this, which, I mean, honestly, we've done so many episodes with this, so many topics. This does change some of the stuff that we spoke on previously. I don't think it completely blows anything up to where it's, it is what it is. But there is a reason for our listeners why we date some of the stuff we do. Like, we'll talk about, the current time when we're speaking on it. If there's something that's planned for the future that we know about, we're talking about that. So there's a reason why intentionally we're talking about, in quote unquote, verbalizing date stamps as we're doing this, because there's already Chris, I can think of 4 or 5 topics we've done. I mean, maybe 120 episodes ago where we've gone and we've redone them. And it's not like we're going to go and delete the other podcasts we did. We're just doing an updated version of it. So I think this bill, this act that's now put into place, again, doesn't explode anything, blow it up that we've done, but you're going to start to see, the listeners, you're going to definitely start to see revisions to stuff that we've put out there in the past. And we'll note that. We'll let everybody know. So you can kind of think of, teaching tax flow as the very transparent source. And there's some stuff that we're not going to talk on. And Chris, tell me if I'm wrong. I don't want to speak for you. Some of the stuff we're not going to talk on if we don't know enough about it. Like, it is what it is, right? So
we're diving in. Absolutely.
Exactly.
Let's talk about a couple. I'm going to wrap this up with a few other key highlights. And again, we're going to definitely, I know it sounds like we're doing our own commercial, but if this hits your ears or eyes, subscribe to our YouTube channel. I can't tell you how much content we're going to put out. In fact, I will probably just create a separate playlist just for the OB3. I think that'd probably be our best option. But charitable contribution deduction now has a 0.5% AGI floor. What that typically means is that only the amount of charitable contributions over that 0.5% of your adjusted gross income are deductible. Miscellaneous itemized deductions. Back in the day, those were called Form 2106 deductions. They went away with the Tax Cuts and Jobs Act. That's where your tax prep fees, unreimbursed employee business expenses, those have been permanently repealed. So that's one thing that actually hurts, quote unquote, many taxpayers. The alternative minimum tax exemption has been enhanced. The estate tax exemption has been increased to $15 million. And a lot of these things take place, a lot of these provisions start in 2025 and some in 2026. So, yeah, a lot of information here. Definitely subscribe to our stuff. We're here to help you out. And start talking to your tax professional about how these changes affect your situation.
Absolutely. Absolutely. And again, Chris, I'm glad we took the time to dive into this. And again, you know what? We're going to do our own damn commercial. That's what we're doing here. So I'll be the one to say it. Frankly, we need the questions that people have on these topics. And the reason why I say that, right, is we're doing our part. We're diving into this as much as we can. Chris, obviously you're taking the perspective of it as the tax pro. Me not being a tax pro, I'm here for the non-hilarious comic relief half the time. And I push the record button on the podcast. That's kind of my role here. But I tend to try to take the taxpayer view on. So that's why, like me and Chris, I think we have a good little synergy going on with these. But honestly, from anybody watching, listening, this has been shared with anything, send us the questions you have on these. We know you have them, send them. Even if we don't directly respond to you with an answer, which we probably will, that literally is what drives our content. And I think with this taking place, this literally being the biggest change, well, some of us may have ever seen in our lifetimes as far as for tax goes, your questions are exactly what we need to hear to answer them in the order of what people have them in, if that makes sense. So basically what I'm saying, don't be lazy. Don't feel that you can't reach out with a question. Chris, you mentioned, join the Defeating Taxes private Facebook group. Drop a comment in there anonymously. Even if you don't ask a question, give us topic ideas from it, because this bill, 1,100 pages, we have enough stuff to go through. We'll find an answer. And if we don't have it, we don't know enough about it, we're going to bring somebody on that does. So case in point, it's happened many times. We love it. We love doing this. Hopefully everybody, I mean, we see it by the numbers, the download numbers. People love listening to this, and we're honored for that. But definitely log on to YouTube, send us that stuff, subscribe, share with a friend. Again, as Chris mentioned, this is impacting pretty much everybody that pays taxes. And even if you don't pay them now, you're going to pay them eventually, and you're still going to be impacted by it. So there's no running from this,
Right.
Unless you move out of the country and take residence in the middle of the ocean. That's a different story. But
There's a lot of rules with that. You can't just, that's
yeah, I shouldn't even
fee.
have said that, because that's a whole thing.
Yes.
So yeah, don't go try to do that. Don't listen to things I say. But as always, as we close this out with, I mean, we love doing this. Again, thank you everybody for kind of following along this little journey, with us. And again, think about this. We went, Chris, 144 episodes ago. We decided, hey, let's do a podcast. Who knows? We'll listen to it, but we'll give it a whirl anyways. Grabbed a pizza box, folded it in half, clipped a mic on top of it, and we went for it. And now we're, leaps and bounds grown, and we love this stuff. So thank you everybody for along for the ride here again, and we'll see everybody back here again on the Teaching Tax Flow podcast. Different date, same day of the week, completely different topic, except for next week, semi-related. So have a great week, everybody. Thank you.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.